This is your Swap Hunt Daily News for March 3, 2026. Crypto markets are navigating geopolitical shockwaves after U.S. Israeli airstrikes triggered a dramatic surge in Iran-linked crypto activity. Markets are holding in neutral territory today, but sentiment remains deep in extreme fear. The total crypto market cap edged lower overnight as broad selling pressure persisted across major assets. Bitcoin is coiling near a key support zone without clear directional commitment. Altcoins are underperforming across the board. The one bright spot, a 5-week institutional outflow streak has officially snapped, with over $1 billion flowing back into crypto funds this week. Within minutes of U.S. Israeli airstrikes hitting Iran, blockchain analytics firm Elliptic recorded a 700% spike in Iran-linked crypto outflows. The speed of the reaction underscores just how deeply crypto has become embedded in geopolitical risk management. When traditional financial channels lock up under sanctions pressure or military escalation, digital assets become an immediate alternative for moving value across borders. Elliptic's monitoring flagged the surge in real time, pointing to wallets and platforms with documented ties to Iranian financial networks. The pattern mirrors what researchers observed during earlier escalation episodes: sudden, concentrated movement out of identifiable addresses the moment kinetic events begin. This isn't speculative, it's documented on-chain behavior triggered by a specific geopolitical moment. For regulators in Washington and Brussels, this episode will add urgency to debates around crypto's role in sanctions circumvention. Enforcement agencies have been pressing exchanges to tighten screening for geography-linked wallet activity. For the broader market, the event is a reminder that crypto doesn't operate in a vacuum. Geopolitical shocks create immediate on-chain consequences, and analytics firms like Elliptic are watching every transaction in near real time. The data will likely feed into upcoming congressional hearings on crypto and national security. $650 million worth of XRP flowed into Binance in a single week, the largest such movement in months, and analysts say the signal is unmistakably bearish. When large volumes of an asset move onto exchanges, it typically means holders are preparing to sell. This isn't retail activity. The scale and concentration of the wallets involved point to significant participants positioning for exits. XRP has already shed more than 60% of its value since its July 2025 peak. The token is trading below its 200-day moving average and has failed to reclaim key structural levels despite multiple attempts. That bearish price structure, combined with this week's exchange inflow data, paints a concerning picture for near-term momentum. It's worth noting the contrast with earlier this week, when XRP exchange-traded products saw 5 consecutive days of inflows totaling nearly $2 million. That institutional buying through regulated vehicles appears to be running against a much larger wave of distribution happening on-chain. The divergence between ETF inflows and spot exchange inflows is a tension worth watching closely. For traders monitoring XRP, the Binance inflow data represents a meaningful warning sign. Historically, exchange and flow spikes of this magnitude have preceded accelerated selling phases rather than reversals. After 5 consecutive weeks of outflows, institutional crypto funds have snapped the losing streak in decisive fashion. CoinShares data shows over $1 billion returned to digital asset investment products this week. Bitcoin exchange-traded products captured the lion's share, pulling in $881 million. Ethereum products attracted $117 million, while Solana funds added nearly $54 million. The United States led the recovery by a wide margin, accounting for $957 million of the total inflows. That figure signals that the institutional pullback observed through much of February was a pause rather than a structural exit. The 5-week outflow streak had drawn comparisons to the darkest stretches of previous bear cycles, making this week's reversal significant from a sentiment perspective. CoinShares analysts noted that the shift coincided with improving clarity around U.S. regulatory direction and stabilizing prices near technical support. It's too early to call this a sustained trend reversal, but the magnitude of the single-week return is notable. A billion-dollar week doesn't happen by accident. It reflects coordinated decisions by institutional allocators who had been sitting on the sidelines and chose this week to re-engage. Whether this marks the start of a fresh inflow cycle or a temporary bounce will become clearer in the coming weeks. Strategy has completed its 101st Bitcoin purchase, adding 3,015 coins to its treasury for approximately $204 million at an average acquisition price just under $68,000 per coin. The company's total Bitcoin holdings now stand at 720,737 coins. That makes Strategy by far the largest corporate Bitcoin holder on the planet. There's a layer of complexity worth unpacking here. Strategy's aggregate cost basis sits significantly above current market prices, meaning the entire position is in unrealized loss territory on paper. And yet, the buying continues. Michael Saylor and the company's board appear entirely unmoved by the drawdown, treating every dip as a buying opportunity rather than a signal to pause. This is the 101st consecutive buy in a streak that has become one of the defining narratives in institutional crypto. The consistency is remarkable regardless of where you stand on the strategy itself. Critics argue the concentration risk is extreme. Supporters point to the long-term compounding thesis and argue that short-term mark-to-market losses are irrelevant to a multi-decade conviction bet. What's undeniable is that strategy is putting real capital behind that conviction at a scale no other corporate entity has matched. The market watches each announcement closely, and this one arrived in the same week that broader institutional fund flows turned positive for the first time in over a month. Bitmine, the investment vehicle associated with Fundstrat's Tom Lee, has made a significant addition to its Ethereum position. The firm purchased approximately $98 million worth of ETH, boosting its total holdings to 4.47 million tokens. This is one of the more notable institutional Ethereum accumulation moves of the year so far. While much of the institutional narrative has centered on Bitcoin treasury strategies in the mold of strategy, Bitmine is making a deliberate and large-scale bet on Ethereum specifically. The timing is interesting. Ethereum has faced sustained price weakness, trading well below its previous cycle highs and underperforming Bitcoin on most major timeframes in recent months. For a fund to deploy nearly $100 million into ETH during a period of weakness suggests a high conviction view on future appreciation from current levels. Tom Lee has been one of the more vocal institutional bulls on crypto broadly, and this purchase backs that positioning with significant capital. CoinShares data from this week also showed $117 million flowing into Ethereum investment products, suggesting Bitmine isn't alone in its accumulation thesis. Whether this represents smart accumulation ahead of a recovery or early positioning in a still declining asset remains to be seen, but the scale of the commitment from a credible institutional name is worth watching. JPMorgan analysts are putting a specific timeline on the next major catalyst for institutional crypto adoption. In a research note circulated this week, the bank's strategist said the Clarity Act, the landmark U.S. digital asset market structure legislation, could be signed into law by mid-2026. If that timeline holds, JPMorgan believes it would unlock a meaningful wave of institutional participation in the second half of the year. The Clarity Act has been years in the making. It would establish clear jurisdiction lines between the SEC and the CFTC for digital assets, provide a legal framework for token classification, and give exchanges and issuers a defined compliance pathway. Those are precisely the conditions that large asset managers have cited as prerequisites for deeper crypto exposure. JPMorgan's analysts were careful to flag that hurdles remain. Legislative calendars are unpredictable, and the bill still needs to clear procedural steps that have slowed previous crypto legislation. But the fact that a bank of JPMorgan's size and conservatism is publishing a constructive second-half outlook based on regulatory clarity signals how significantly the institutional posture has shifted in 2026. A year ago, this kind of note from JPMorgan would have been unthinkable. Today it reads as a considered research call from analysts tracking Washington closely. For long-term investors, regulatory clarity has always been the missing piece. JPMorgan is now suggesting it may arrive sooner than the market currently prices in. That's your daily crypto roundup for March 3rd. If this helped you stay informed, subscribe to Swap Hunt HQ here on YouTube and follow Swap Hunt on X for real-time market alerts. See you tomorrow.